The biggest mistakes aren't made by stupid people. They're made by smart people who overthink. I've been thinking about Warren's operating methods, and there's something remarkable about how they align with what we now understand about human cognition. When we started, we had no idea that psychological research would eventually confirm that making important decisions while fatigued is a recipe for poor judgment, or that the simple act of consuming caffeine and sugar could sharpen decision-making capacity. Warren stumbled into these practices naturally. Both he and I live almost entirely on autopilot for life's mundane choices. We're creatures of pure habit in the trivial matters. This isn't laziness or eccentricity, it's conservation of mental energy.
We don't squander our decision-making capacity on what to wear or what to eat.
Warren consumes caffeine and sugar regularly, and under modern psychological evidence, this turns out to be nearly ideal for someone sitting where he sits, making the decisions he makes. He didn't engineer this consciously. He simply drifted into patterns that worked. I genuinely cannot recall a single important decision Warren made while tired. He's never exhausted when it matters. He sleeps soundly, wakes refreshed, and doesn't waste cognitive bandwidth debating his breakfast. His entire approach, which appears peculiar to outsiders, is actually a masterclass in preserving judgment for when it counts. People love to romanticize investing as an arena for brilliant minds. They picture someone surrounded by flickering screens, spreadsheets glowing deep into the night, endlessly refining assumptions and testing hypotheses. This image is comforting. It flatters our egos and validates intellectual labor. It's also fundamentally wrong. In my decades of experience, the people who stumble into the most catastrophic investment decisions are often extraordinarily intelligent, sometimes too intelligent for their own good. They confuse frenetic intellectual activity with sound judgment. They mistake perpetual motion for genuine progress. The uncomfortable truth is that investing doesn't reward the person who thinks the hardest or the longest. It rewards the person who consistently avoids monumentally stupid mistakes. That distinction matters far more than most investors ever realize. Overthinking masquerades as discipline, but in reality, it's usually fear wearing expensive clothes, fear of being wrong, fear of looking foolish, fear of acting without perfect certainty in a world that will never offer it. So people analyze, then analyze again, then analyze what they've already analyzed. By the time they feel ready to act, the opportunity has either evaporated or, worse still, they've convinced themselves of something that looks brilliant on paper but behaves catastrophically in actual market conditions. I've watched this pattern repeat itself for decades across countless investors. Most terrible investment decisions don't stem from ignorance. They emerge from misapplied intelligence, a powerful mind pointed in precisely the wrong direction, capable of inflicting tremendous damage. Warren and I never believed our job was to make clever decisions. Our job was to make few decisions and ensure they weren't stupid. That represents a fundamentally different mindset. Modern culture worships complexity. If something is simple, people reflexively assume it must be naive or unsophisticated. If it requires elaborate explanation, they assume it must be brilliant. Investment bankers are particularly enamored with this illusion. Hand them a declining business and they'll still project rising earnings in their pitch books. After all, nobody closes a deal by saying, "This will probably deteriorate." Warren and I never suffered from that problem. We were perfectly willing to purchase businesses where earnings would decline if the price adequately compensated us and the operational effort required remained minimal. That single principle alone eliminates an astonishing amount of overthinking. The brilliant decision-maker believes his edge comes from forecasting the future with precision. The experienced decision-maker knows the future is mostly noise and focuses relentlessly on avoiding obvious errors in the present. That's not pessimism. It's realism tempered by experience. Overthinking often begins with a false premise, that more information invariably leads to better decisions. It doesn't. Beyond a certain threshold, additional information doesn't clarify, it confuses. It introduces conflicting signals, marginal distinctions, and false precision. You start optimizing to the third decimal place while missing opportunities measured in whole dollars. I've watched people systematically destroy perfectly sound ideas because they couldn't stop refining them. They kept asking one more question, running one more scenario, waiting for one more data point. Eventually, the opportunity expired while they were still thinking. There's a reason Warren and I never attempted to predict macroeconomic cycles, interest rate movements, or next quarter's GDP figures. It's not because those variables are irrelevant. They clearly matter. It's because they're extraordinarily difficult to predict reliably, and pretending otherwise encourages the worst kind of overthinking. Instead, we preferred obvious logic. Is this business genuinely understandable? Is the balance sheet robust? Is the price sensible relative to intrinsic value? Is the downside survivable if things go wrong? If those fundamental boxes checked out, we didn't need a 200-page report to feel intelligent. We needed the courage to act and the discipline to stop thinking. That last part is profoundly underrated. People assume the hardest part of investing is analysis. It isn't. The hardest part is knowing when further analysis actively makes you worse off. Overthinking also feeds the dangerous human desire to be right rather than to make money. Once your ego becomes entangled with an investment thesis, you start defending your ideas instead of evaluating them objectively. You seek confirmation rather than truth. That's precisely how intelligent people stay poor despite their capabilities. Warren once joked that he couldn't remember an important decision he made while tired. That wasn't accidental or lucky. Sound judgment requires a rested mind operating at full capacity. Overthinking typically happens when the mind is already fatigued and desperately searching for certainty it cannot find. The brilliant decision-maker believes effort equals virtue, that if a decision consumed months of grueling work, it must be good. Reality doesn't cooperate with that logic. Some of our best decisions took minutes, not because we were reckless, but because the logic was crystalline and the alternatives were clearly worse. Simplicity is not stupidity. It's often the byproduct of long, hard-won experience. Once you've lived through enough market cycles, you stop romanticizing complexity. You learn that most things don't need to be optimized. They need to be avoided. Avoid leverage you don't actually need. Avoid businesses you don't genuinely understand. Avoid partners you don't fully trust. Avoid decisions that require you to be heroic. Do that consistently and you'll outperform legions of people who spend their entire lives trying to be clever. So when I hear investors boast about how much time they devote to thinking, I don't feel impressed. I feel nervous for them. Because in investing, brilliance is entirely optional. But discipline, restraint, and knowing when to stop thinking? Those are mandatory. And if that sounds too simple, well, that's usually the first sign you're overthinking. One of the great flaws in how people conceptualize decision-making is assuming the brain functions like a machine. Turn it on, it runs at full power, and as long as you keep feeding it information, it maintains peak performance. That's complete nonsense. The human mind operates more like a battery. Every serious decision drains it incrementally. Once it's depleted, the quality of your judgment collapses precipitously, often without you noticing the deterioration. Modern psychology eventually documented this phenomenon. Warren and I discovered it the old-fashioned way, by watching people make terrible decisions late in the day, including extremely intelligent people who should have known better. Decision fatigue isn't dramatic. It doesn't announce itself with flashing warning signs. You don't feel stupid or impaired. You feel thoughtful and engaged. That's what makes it so insidious and dangerous. By the time people start overthinking, they're usually already cognitively exhausted. They don't recognize it, so they keep pushing. More spreadsheets, more scenarios, more, just one last look at the numbers. What they're actually doing is demanding precision work from an exhausted mind, and that never ends well. This is why Warren's lifestyle, which people love to mock as eccentric or simplistic, turns out to be almost perfectly engineered for sound judgment. He doesn't waste mental energy on trivial decisions. He doesn't stand in front of a closet each morning deciding who he wants to be that day. He doesn't treat food choices like moral exercises requiring deliberation. He eats what he's always eaten. He sleeps when he's tired. He wakes up rested and ready. People interpret this as lazy or peculiar. It isn't. It's profoundly disciplined. Every unnecessary decision you eliminate preserves precious energy for the decisions that genuinely matter. That principle applies to life generally, and it applies even more critically to investing specifically. Overthinking is often the symptom of cognitive overload masquerading as intellectual rigor. When the brain is fresh and well-rested, good ideas feel obvious and clear. When the brain is tired, everything feels unnecessarily complicated. That's why people get lost in trivial nuances at exactly the wrong moment. They start arguing about infinitesimal differences while completely ignoring the big picture. I've watched investors debate valuation multiples down to the second decimal place while somehow missing the glaring fact that the underlying business itself was mediocre at best. That's fatigue talking, not analysis. There's a profound reason Warren couldn't remember making an important decision while tired. Important decisions deserve a fresh mind operating at peak capacity. If you can't wait until tomorrow to decide, the decision probably isn't as urgent as you think, or you're about to do something foolish. This connects directly to overthinking. Most overthinking happens late in the day, late in the analytical process, late in the emotional cycle. By that point, people aren't genuinely searching for truth. They're searching for relief from uncertainty. They desperately want certainty so they can stop thinking, but certainty isn't available in investing. So they keep grinding and grinding until eventually they convince themselves of something, not because it's actually correct, but because they're mentally and emotionally exhausted. That's precisely how intelligent people talk themselves into bad investments. The antidote isn't more intelligence or more analysis. It's fewer decisions, more carefully spaced. Warren and I always believed you should conserve your decision-making capacity the way a pilot conserves fuel. You don't burn it taxiing in circles on the runway. Most people do exactly that. They exhaust themselves on small, easily reversible choices. Then when a large, irreversible decision arrives, they're completely depleted. At that point, overthinking becomes inevitable. The brain, sensing danger but lacking energy, slows everything down. It demands more information. It manufactures doubt that feels prudent but often isn't. Sound judgment requires both rationality and proper timing. If you wait until your mind is worn out, you're already operating at a severe disadvantage. This is one reason we favored habits and routines so strongly. Not because routines are virtuous in themselves, but because they systematically remove friction and decision points. Autopilot isn't stupidity. Autopilot is conservation of scarce mental resources. You want your best thinking available when it genuinely matters, not squandered on trivia. In investing, this means you don't constantly tinker with positions. You don't monitor prices obsessively throughout the day. You don't react reflexively to every piece of news that crosses your screen. That behavior feels active and engaged. It feels like you're working. In reality, it's usually just exhausting without being productive. The market is extraordinarily good at draining your energy if you allow it. Noise is cheap and constantly available. Stimulation is endless. If you consume all of it indiscriminately, you will overthink by default. And when you overthink, you stop seeing what's obvious. The obvious is where most of the money actually gets made. Simple mispricings, transparent incentives, clear human behavior patterns. Those things don't require brilliance. They require a calm, rested mind capable of seeing clearly. So if you genuinely want to improve your investment results, don't start by reading more books or building more elaborate models. Start by protecting your judgment. Sleep properly. Simplify ruthlessly. Reduce the sheer number of decisions you make in a day. And above all, recognize this fundamental truth. When your thinking starts to feel heavy, tangled, and desperate for certainty, that's not a signal that you should think harder. It's a signal that you should stop completely. Because an exhausted mind doesn't need more analysis. It needs rest and fewer decisions to make. One of the most persistent and costly mistakes in investing is the belief that a good investment must sound exciting. People want a compelling story. They want growth curves pointing dramatically up and to the right. They want something they can enthusiastically discuss at dinner parties. That desire alone eliminates a vast number of perfectly rational opportunities. Warren and I never required excitement. We required sense. If an idea could be explained in a few straightforward sentences, and those sentences held up under scrutiny, we were interested. If it required an elaborate presentation to justify why reality might eventually cooperate with the projections, we usually passed. That disciplined approach saved us an enormous amount of trouble over the decades. Consider our investments in newspapers. To many observers, this looked completely irrational. The industry was in unmistakable decline. Circulation was falling. Advertising was migrating elsewhere, particularly to digital platforms. All of that was demonstrably true. What confused people was their assumption that we were trying to buy a growth story or bet on a renaissance. We weren't. We were buying assets at very low prices relative to current earnings, with a clear-eyed expectation that earnings would decline but not collapse overnight, and that the capital required to operate these businesses would remain modest. That's not romance or optimism. That's arithmetic. Most investors are trained to reject declining businesses on principle.
They've been taught that shrinking earnings automatically disqualify an investment. That's lazy, undisciplined thinking.
A business with declining earnings can be a perfectly sound investment if the price more than compensates for the anticipated decline. The reverse is equally true. A rapidly growing business can be a terrible investment if the price assumes miracles and perfect execution. This is where overthinking quietly enters through the back door. People build elaborate models attempting to predict growth trajectories 10 years out. They argue endlessly over terminal values and discount rates. They debate scenarios that are fundamentally unknowable. All of that intellectual effort is focused on the wrong question entirely.
The right question is dramatically simpler. What do I have to believe for this investment to work? In the case of newspapers, we didn't have to believe in an industry renaissance. We didn't have to believe in digital dominance or successful pivots. We didn't have to believe anything remotely heroic. We only had to believe that the decline would be gradual rather than catastrophic, and that the businesses would continue throwing off substantial cash for a considerable period. That was not a heroic assumption. It was reasonable given the evidence. Investment bankers, of course, never sell deals that way. Their pitch books invariably show rising earnings. Decline is quietly edited out of the projections. Reality proves less cooperative. Warren once pointed out the irony. When we buy businesses, we often explicitly expect earnings to decline. When others sell businesses, they expect earnings to rise, at least on paper and in their presentations.
Guess who usually ends up with the advantage in that transaction?
Simple ideas carry another crucial virtue. They don't require constant supervision or intervention. The newspaper investments didn't demand extraordinary attention from headquarters. They didn't require new systems, heroic management interventions, or constant strategic pivots.
That matters enormously.
A decent return that requires no additional effort or attention is often genuinely superior to a potentially higher return that demands constant mental energy and involvement. Most people dramatically underestimate the real cost of attention. They see only the numerical returns.
They ignore the wear and tear on judgment and mental capacity. Warren was crystal clear about this principle.
The newspaper investments would never move the needle at Berkshire given our scale. They were too small relative to our total capital.
But they didn't have to be transformative. They were rational.
They were purchased at sensible prices with clear logic. They carried limited downside risk.
That was sufficient.
Overthinking thrives in environments where people believe every single decision must be extraordinary or exceptional. It doesn't.
A portfolio constructed from a series of solidly good enough decisions will systematically outperform one built around a few heroic ideas that require flawless execution.
The cultural obsession with brilliance causes investors to systematically overlook opportunities that appear dull or boring. And dull opportunities often come with one critical, underappreciated advantage: fewer competitors.
Most people cannot psychologically tolerate them.
They would genuinely rather lose money in something exciting than make money in something boring. That's not accidental. It's deeply embedded human nature.
But investing is not a popularity contest.
It's a weighing machine that operates over time.
Simple logic applied consistently beats complex logic applied occasionally. If you find yourself attracted to an investment primarily because it makes you feel clever or sophisticated, that should genuinely worry you.
Feeling clever is not a reliable indicator of future returns.
Warren and I were always more comfortable with ideas that made us feel calm. Calm means the underlying logic is clear and sound.
Calm means the downside is tolerable even if things don't go perfectly. Calm means you don't need to revisit the decision every week to reassure yourself. Overthinking, by contrast, keeps you emotionally entangled and anxious. You're constantly checking prices, constantly second-guessing, constantly adjusting assumptions. That's a reliable signal that the idea was intellectually fragile to begin with. Genuinely good investments don't require constant intellectual maintenance or justification.
They work because the underlying logic is fundamentally sound, not because you keep repairing it with new rationalizations.
So when you evaluate an opportunity, don't ask how impressive it sounds to others or how clever it makes you appear. Ask something far more important. If this investment turns out to be merely adequate rather than spectacular, am I still genuinely satisfied with the outcome? If the answer is yes, you're probably thinking clearly. If the answer is no, you may already be overthinking and setting yourself up for inevitable disappointment. One of the great diseases afflicting modern investing is the relentless pursuit of perfection. People want the perfect entry price,
the perfect business with no flaws, the perfect forecast of future conditions. They don't realize that perfection is usually just procrastination wearing a nicer suit. Warren and I never attempted to make perfect decisions. We tried to make decisions that were clearly better than the realistic alternatives available. That difference sounds small and semantic. It isn't. It's everything. Perfection requires complete information. Complete information does not exist in investing or anywhere else. So the investor who demands it is guaranteed to wait too long or never act at all. This is where overthinking quietly destroys returns over time. People sit on mountains of cash because nothing feels perfect. They keep refining their criteria. They incrementally raise the bar until no real-world opportunity can possibly clear it. Meanwhile, time passes relentlessly. Inflation erodes purchasing power. Opportunities compound elsewhere, in the hands of people willing to act. The cost of inaction is rarely visible on any statement, which is precisely why it's so dangerous and insidious. At Berkshire, we never required every investment to move the needle or be transformative. If we had imposed that standard, we would have done far fewer sensible things over the decades. Some investments were simply decent, rational uses of capital. They didn't require genius. They didn't demand constant attention. They didn't require us to be heroes or make perfect decisions. They were good enough. That's a concept many investors genuinely struggle with psychologically. They assume that because Berkshire grew large, every decision must be extraordinary. In reality, the discipline was precisely the opposite. Only extraordinary errors were truly unacceptable. A modest low-risk return that requires minimal effort is often genuinely superior to a potentially spectacular return that demands flawless execution and constant attention. Overthinking systematically flips that logic on its head. It convinces people that unless an idea is exceptional and extraordinary, it isn't worth pursuing. So they reach for risk. They add leverage to boost returns. They accept fragile assumptions. They stretch timelines and make heroic projections, all in the name of being right or looking brilliant. But investing does not reward elegance or sophistication. It rewards endurance and survival. A portfolio doesn't collapse because it lacks brilliance. It collapses because it contains too many intellectually fragile ideas that cannot withstand normal adversity. Fragility often hides effectively behind sophisticated language and complex analysis. If an investment requires everything to go right according to plan, it is not a great investment, no matter how clever or impressive the thesis sounds when you present it. We systematically preferred investments that could tolerate genuine disappointment and adversity. If growth slowed materially, the investment still worked. If margins compressed, the investment still worked. If management made a few predictable mistakes, the investment still worked. That is what good enough genuinely means in practice. It doesn't mean careless or sloppy. It means robust and resilient. The pursuit of perfection also leads people to completely ignore the crucial dimensions of scale and effort. They focus almost entirely on return percentages and forget to honestly ask how much attention and mental bandwidth the investment will consume over time. A 12% return that requires no mental energy can be far superior in practice to a 15% return that keeps you awake at night and demands constant monitoring. Most investors never factor that trade-off into their analysis. They should. It matters enormously. Mental energy is a genuinely finite resource. Once it's depleted, mistakes inevitably follow. Warren once remarked that some investments were particularly attractive precisely because they didn't require an extra ounce of effort from headquarters. That wasn't laziness or lowering standards. It was rational allocation of scarce attention. If an investment doesn't distract you from more important decisions, it possesses hidden value that doesn't appear in any spreadsheet. Overthinking systematically blinds people to this critical trade-off. They see only the upside scenario in their models. They completely ignore the ongoing cost of involvement and the wear and tear on judgment. There is also a powerful social element driving perfectionism. People want to be admired for their investment decisions. A good enough investment doesn't earn admiration from peers. It earns indifference. That genuinely bothers people at a deep psychological level. So they choose unnecessary complexity. They choose novelty. They choose ideas that sound impressive at cocktail parties. And they accept risks they don't fully understand in the process. Warren and I had absolutely no interest in admiration or appearing clever. We were interested exclusively in results. If something worked quietly, year after year without drama,
we were entirely satisfied. In investing, boring is often genuinely beautiful. The profound irony is that once you genuinely accept good enough as a standard, decision-making becomes dramatically easier, not harder. You stop chasing ideal conditions that will never arrive. You stop waiting for clarity that reality will never provide. You act decisively when the odds are favorable, not when they're perfect. That's how capital actually compounds over decades. So if you find yourself endlessly refining an investment idea, constantly adjusting assumptions, and perpetually waiting for conditions to line up just right, pause completely. Ask yourself one simple, honest question. Am I trying to avoid being wrong, or am I trying to make money? Because the investor who insists on perfection usually achieves neither goal. They end up with cash that inflates away while opportunities pass them by. Overthinking doesn't only manifest in stock selection. It shows up even more clearly and destructively in how people attempt to control outcomes after decisions are made. The more insecure someone is about their fundamental judgment, the more they interfere and micromanage. They monitor obsessively. They second-guess constantly. They demand updates and explanations. They call this prudent risk management. Most of the time, it's just overthinking wearing the clothing of authority. Warren and I took a fundamentally different approach when we brought Todd Combs and Ted Weskler into Berkshire as investment managers. We didn't hire them to imitate us or follow some prescribed formula. We hired them because they had demonstrated sound judgment over time. And once we decided that, we deliberately stayed out of their way. We didn't tell them how many stocks to own. We didn't tell them what industries to avoid beyond a few narrow legal constraints. We didn't tell them how to diversify or construct portfolios. They could put all their allocated capital into one stock if they wanted. They could own 50. That degree of freedom shocks people when they hear about it. They reflexively assume such autonomy is reckless. In reality, it's a filter. Only someone with genuine discipline and sound judgment can operate effectively with that kind of responsibility. Micromanagement is a particularly insidious form of overthinking that metastasizes. It doesn't just exhaust the person doing it, it systematically weakens the people being managed. If every decision is second-guessed and questioned, people stop thinking independently. They start optimizing for approval instead of outcomes. That's precisely how organizations lose judgment capacity. The same destructive dynamic happens to individual investors. They ask 10 different people for opinions. They read 20 commentaries from various experts. They wait for consensus before acting. By the time they finally act, they're not following their own reasoning anymore. They're following the average of other people's anxieties and biases. That is not diversification or prudence. That is delusion. When Warren managed money earlier in his life, he wanted one thing above all else: freedom to act on his judgment without interference. If people wanted to give him money to manage, they could make that decision. But once they did, he didn't want his hands tied by constant questions or restrictions. That fundamental principle never changed over the decades. Responsibility without authority is a recipe for poor decisions. Authority without trust is even worse. Overthinking thrives in environments where no one feels fully accountable. When everyone is half responsible, genuine judgment disappears entirely. Delegation done properly actually reduces overthinking because it forces clarity. You either trust someone completely or you don't trust them. If you don't trust them, don't give them the job. If you do trust them, don't suffocate them with interference. There is no productive middle ground that works. For the individual investor, this lesson applies internally to your own process. You have to decide whether you trust your own analytical framework. If you don't, no amount of external confirmation will fix that fundamental problem. You'll just borrow other people's confidence temporarily. Eventually you'll face a moment when opinions diverge sharply. They always do. At that point, overthinking rushes in powerfully. You hesitate. You reevaluate everything. You freeze. Not because the underlying situation changed, but because you never fully owned the decision to begin with. Warren and I were entirely comfortable being different from consensus. We bought things others actively avoided. We ignored things others loved. That wasn't contrarianism for its own sake or being difficult. It was the natural result of independent thinking combined with trust in our judgment. Micromanagement destroys independence. Overthinking destroys decisiveness. Both come from the same root source: fear of being wrong. But investing doesn't allow you to outsource responsibility to committees or consensus.
You can listen to others. You can learn from them.
But the final decision has to be yours. Once it is, constant interference only makes things worse. That's why we didn't hover over Todd and Ted, monitoring their every move. And it's why we didn't constantly tinker with our own investments.
We made decisions. We lived with them.
We adjusted only when the underlying facts changed materially, not when our emotions did.
That discipline is genuinely rare.
Most people confuse activity with control.
They confuse involvement with insight.
True control comes from selecting well initially, not from interfering endlessly afterward.
If you find yourself constantly checking positions, constantly adjusting, constantly seeking reassurance, ask yourself honestly why.
Is the investment actually fragile, or is it your confidence that's fragile? Because no amount of micromanagement will fix the second problem, and overthinking will only make the first one worse.
After all the discussion about intelligence, analysis, and discipline, investing eventually comes down to something far less glamorous: knowing when to stop thinking. Most people never master that critical skill. They assume wisdom means continuing to think, continuing to refine, continuing to search for certainty.
In reality, wisdom often means recognizing that further thinking will not improve the decision and may actively harm it. Warren and I saw this most clearly during periods of genuine crisis and panic. Take the Harley-Davidson deal during the financial meltdown. The corporate bond market was completely frozen. Panic was everywhere. Credit had evaporated. We didn't build a decade-long forecast for motorcycle demand. We didn't model lifestyle trends. We didn't speculate about brand relevance in 2030. We asked a much simpler, more fundamental question. Is this company going to go broke in the near term? If the answer had been yes, we would have walked away immediately. If the answer was no, and we believed it wasn't, then the terms being offered were extraordinary.
15% yield.
You don't need brilliance to understand that 15% in a world starving for capital is attractive. You need nerve and restraint. Restraint to not overthink yourself out of what's obvious. That's the paradox many investors never resolve. The clearer an opportunity appears, the more people feel psychologically compelled to complicate it.
They add conditions. They add caveats.
They invent risks that weren't there in the original analysis. Not because the risks are genuinely real, but because acting feels too easy.
Easy decisions make people deeply suspicious.
They assume they must be missing something crucial.
Sometimes they are.
Most of the time they're just uncomfortable with simplicity.
The skill is learning the difference between genuine risk and manufactured anxiety.
We always believed that if an investment required constant explanation and re-explanation to ourselves, it probably wasn't good enough to begin with. A genuinely sound decision should settle the mind, not agitate it. That doesn't mean there's no doubt. There's always doubt in any real decision. But there's a profound difference between healthy uncertainty and mental noise. Healthy uncertainty says, I understand the risks clearly and I can live with them. Mental noise says, I don't really believe my own reasoning, so I'll keep circling endlessly.
Overthinking lives in that circle.
At some point in every investment decision, the information stops changing, but your emotions don't. You start reacting to your own anxiety instead of the objective facts. That's when you should stop completely. Another mistake people make is believing that great investors are constantly active and busy.
They aren't. Most of the money is made by waiting. Waiting for mispricing, waiting for panic, waiting for stupidity, which is never in short supply.
When the right moment arrives, the decision should be relatively quick. Not impulsive or reckless, but decisive. If it takes months of agonizing to convince yourself, the odds are the opportunity isn't as good as you think, or you don't trust your own framework. Either way, thinking longer won't fix either problem.
Warren once said that investing is easy to explain but hard to do.
This is why the explanation fits on a napkin. The execution requires emotional control.
Knowing when to stop thinking is a crucial part of that control. It means accepting that you will sometimes be wrong.
It means resisting the powerful urge to optimize every outcome. It means acting when the odds are favorable, not perfect.
Most people never do this because being wrong feels worse than missing an opportunity. That's completely backwards.
Miss enough opportunities and your future is decided quietly, without drama or headlines.
Warren and I never believed we had to be right all the time. We believed we had to be right when it mattered most. That requires selectivity. And selectivity requires the discipline to say no. Not just to obviously bad ideas, but to unnecessary thinking.
So here is the unglamorous truth that nobody wants to hear. The hardest part of investing is not learning how to think. It's learning when to stop.
When the logic is sound, when the downside is acceptable, when no new information is likely to change the conclusion materially, that is the moment to act.
If you hesitate then, you're not being cautious or prudent. You're being afraid. And fear dressed up as analysis is still fear. The investor who genuinely understands this doesn't look busy or impressive. He doesn't look particularly clever. He often looks bored. But over time, that boredom compounds into something remarkable, while overthinking compounds into nothing but exhaustion and missed opportunities.